Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So the seller prefers a lack of movement and the buyer prefers movement. Options have value for basically two reasons. And if you're having any kind of problems with the sound, your internet service provider is probably throttling back, because I'm on a very good network right now. So it's not me. Unfortunately, I have one person saying they can't hear. You might want to call the number. You can go up to communicate and call into a number, but it's your internet service provider, so thank you. Options have value for two reasons: the cost of money, and I call that the interest rate differential for currency options, and volatility. So if options had, if there were no interest rates and there were no volatility, all options would trade at intrinsic value or zero. We know that's not the case. So what are we trading? Well, we look at these inputs: the price of the exchange rate value, strike price, time left until expiration, risk-free rates, which is the interest rate differential here. When I'm trading currencies, I'm looking at the interest rate differential, one country to another, the dividends of the underlier, and then, most importantly, volatility. And we're going to talk about volatility. So what is volatility? Lots of ways to define it. Uncertainty. What is that? Well, it's the lack of certainty, a state of having limited knowledge where it is impossible to exactly describe existing state or future outcome. More than one possible outcome. Options are based on uncertainty. So you might look at a chart, and if you believe that a certain exchange rate is in a breakout, common sense tells you that even though the trend is up or down, it might not go on forever. In fact, it could actually might snap back. You might have a false breakout. So options give you the ability to have limited risk if you're a buyer. Options are based on this uncertainty. So when we talk about volatility, there's lots of ways to talk about it, but normally when we talk about volatility, we express it in annualized terms. So it can be expressed in an absolute dollar amount or a fraction, but essentially, when I talk about a 10 vol, that means that the exchange rate pair value should move about 10% over 1 year's time. Let's take one step back and talk about it from a practical sense. What does this all mean? Well, options are based on statistics. So you need to understand a little bit about statistics. You don't have to be an expert on it, but just a little bit so you can have a decent background. So I used the example of American women's heights, age 18 to 24. The average or the mean is 65.5 inches, and the error factor, I call it the standard deviation, is 2.5. So we can actually get 68% of all women are going to be somewhere between 65.5 plus or minus 2.5 inches, or 63 to 68 inches. That's 68%. So it gets 68%, 34 taller, 34 shorter. I can actually go to 2 standard deviations and get to 95% and just add another 2.5 on either side. What does all that mean? Well, what I'm saying here is that I might have confidence levels of 68 or 95, but you know what? We never get to 100% confidence level. We still have uncertainty, so we never get to this. We never get to 100%. Practically speaking, one example could be the female heights, right? It could be tall women all the way to the right, shorter women to the left. I hope you know where this is going. We're going to take it to the exchange rate. So today's rate, let's just say it's US dollar Canadian, and we're trading around 100. Here it is, a 100. You might be looking for a bullish scenario for the dollar. You might be looking for a bearish scenario for the US dollar. Essentially, the model says that the most likely price for the US Canadian, if it's trading at 100 today, is 100 a year from now. That's the theory behind it. That's all we have. It's a model. It's theory. So the most likely price is where it is today. Will it be trading at 100 a year from now? I doubt it. That's just the model. It might be much higher or much lower, and that's where these options are, how they're priced. They're priced off probabilities. So for those of us that use technical analysis, we might say, oh, we're in a bear trend here, or we're in a bull trend. What we're saying here is that the options market believes that it's just as likely for the asset to move up as move down. What's important is what we pay for this option premium. You never really know if you pay too much, or obviously you hope you pay too little and you got a good purchase. You don't know that until the future when the market starts to trade, meaning what will happen to this underlying exchange rate value? Will it be more volatile or less volatile? When you're a buyer of an option, you'd love for the exchange rate value to, of course, if you're a buyer or call, you want it to go up, but you'd love for it to be volatile when it's moving up, meaning it goes up 7, down 4, rather than going up 1 cent a day. That doesn't really help you all that much if you're a buyer of a call option. Buyers want volatility. Sellers want a lack of volatility. So that's how, again, I'm always trying to take it back in this next 45 minutes to volatility. If you're right about direction but wrong about volatility, you might not make any money. However, if you're right about vol but wrong about direction, you might not lose money. So if I get to options pricing, we have the price of the underlier, the strike price, the time, the cost of money, and then the volatility. I get the volatility, or normally you look at the historic volatility, and you can actually solve for the theoretical value of an option. You can actually do this at FX Options. We have tools there. We have an options calculator. Urge you to go and check that out. Another way to look at it is if you take the price that comes from the ICFX options market, you could solve for what's called the IV, or the implied volatility. What volatility is making that price fair? And that's how we can really get a general sense if the option is, again, cheap or expensive based on some period of time. Because, if you really think about it, options are always traded at a fair price, because wherever somebody's willing to buy one, well, that's a fair price, at least at the moment. So the implied volatility will tell you, based on a certain period of time, if options appear to be rich or expensive, rich or cheap. But again, options, at least as far as supply and demand are concerned, are fairly priced anytime we find a buyer and a seller. The reality of pricing, well, options have value for basically 2 reasons: the cost of money and the probability of price change. These movements are occurring all day long, so we have exchange rates moving, times changing, interest rates are changing, and future volatility is probably going to change. Now, this is a very interesting point. I'm going to spare you the math, but I want you to understand that if you were to take the volatility of an asset, divide by the square root of trading days, you could come up with a rule of thumb for how volatile a certain asset might be over a certain period of time, over 1 day's trading.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.